In our next lecture examples, we are going to look at the basics when we do some practice examples. Now, important, you should not continue with the rest of the lecture until you've mastered these basics. If you can't understand these basics, please don't continue and look at the rest of the sections on it as they get a bit more complicated. You must understand this. Right, so I'm going to save you time. I'm not going to rewrite the solutions, but we're going to go through it, all of them. Right, so Mr. X passed away in 2005. In terms of his last will and testament, he bequeathed the following assets to the family trust. Bequeathed means you left it in terms of the will. So I want you to understand that this means there was no donation. So that's important. If you think back to our approach, was there a donation and is the donor alive? No. So we are looking at section 25B. It says there was a block of flats that had a market value of 5 million rands and shares in this company which are worth 400,000 rands. They tell you that the X family trust was created for the benefit of Mr. X's wife, which is Mrs. Y, and his 2 children, child A and child B. In the current year, child A was 27 years old and child B was 16 years old. Now, I'm going to just point out something here which is very important, and that is that child B is a minor. Now, the problem is what a lot of people will do is immediately when they see the minor, they want to go and apply section 7.3. But you have to remember that there was no donation. So you cannot apply section 7. Section 7 only applies if you say yes to the question about whether or not there was a donation. So that's important to remember. And Mrs. Y is 55 years old. In terms of the trust deed, child A and child B each have a vested right. Right? See there? A vested right to 50% of any rental income that is generated by the block of flats. This must be paid out to them by the end of the year of assessment in which it was generated. No beneficiary has a vested right to any amounts generated by the shares. The trustees may use their discretion to distribute the amounts of the beneficiaries, and in the current year they paid out an amount to Mrs. Y. Then they give us what is called a distribution table. This should usually be given to you. Now what I want you to understand, at the top of the distribution table I always recommend, here where you see the income sources, you write if there was a donation or not. In this case there was no donation. So remember guys, again, if we go to our approach, we can only consider section 25B for this. Okay, so first up, let's just see, you'll see usually this is common to see income less trustees remuneration. This trustees remuneration over here, right, so there's a total column. That amount will be taxed in the hands of the trustee as gross income. You are concerned with the following. Each of these, well, not the total column, just be careful. Each of these amounts that I'm highlighting, you need to be able to discuss who is going to be taxed on it. That's what we do with the question. So they ask you to calculate the taxable income for child A, child B, Mrs. Y, Mr. X, and the trust. Alright guys, so what we're going to do the whole time is just this approach. Was there donation? Is the donor alive? Yes or no? No? Consider section 25B. Who has a vested right? Or that the trustees use the discretion, then the beneficiary should be taxed. If not, then the trust is taxed. So we're going to go through that the whole time. I'm going to annoy you with this now, but I want you to, in an exam situation, do the same thing. So, first one, we look at this child A had rental income of 339,500. Was there a donation and is the donor still alive? No. So there's no section 7 that we should consider. Does someone have a vested right to it? Yes, they do have a vested right to it. That's what they said. So that person with the vested right, child A, must be taxed on it. Right, so make sure you see, we go to child A, there he gets taxed on it. Right, so that one is done. Next one is the 339,500 to child B. Child B, I'm reminding you, is a minor. Right, that 339,500. Was there a donation and is the donor still alive? No. So we consider section 25B. So remember again, section 7 only applies if you say yes to the donation. Because there was no donation, we don't consider that. Section 25B says nothing about age. So who will be taxed on that 339,500? Child B will be taxed on it. So make sure you see child B, 339,500. Right. Mrs. Y got none of the dividends. There's nothing retained in the trust. Right. Then, child A, child B, and Mrs. Y. Nothing for the dividend, nothing. They gave 100,000 rands to Mrs. Y. Does she have a vested right to it? No. But they did use their discretion to pay it to her. If they use their discretion, she will still be taxed on it in terms of section 25B2. So that 100,000 rands, who will be taxed on it? Mrs. Y. So we go down to Mrs. Y. Make sure you see 100,000 rands. Because the conduit pipe principle applies, she received a dividend, so it's still exempt. Make sure you see that. Right. Then the 191,000 rands that is retained in the trust. Does somebody have a vested right to it? What is this? This is dividend income. They tell you no one has a vested right to it. So I'm going to take you here. Does someone have a vested right to it, or did they pay it out? This question you can never ask for the income retained in the trust, because if it's retained in the trust, they didn't pay it out. Right, so does someone have a vested right to it? Was it paid out? No. So who should be taxed on it? The trust. So that 191,000 rands there gets taxed in the hands of the trust. So look, the trust, 191,000 rands. Very important, guys. They still get the exemption. The exemption for dividends does not only apply to natural persons. Right. And Mr. X was dead the entire year, so he can't be taxed. So guys, that is in simple terms, when there is no donation, make very sure what you should walk away with from this specific class now, or this little example, is that even though the minor child, or the child is minor, they were still taxed on it because there was no donation. This next example is a big question. It's an important question. You cannot continue until you know how to answer this question. I do not expect you to see a question of this size in an exam, but definitely these type of principles will apply. So this is a very comprehensive one to work through. Okay, so it's going to have to require to keep your wits about you. The whole time we are going to come back to our approach. So again, remember, I'm going to ask the following question. Was there a donation, and is the donor still alive? If you say yes, you'll say, does section 7 apply? If you say yes, then the donor is taxed. Right, so there's section 7, section 7.2, donation to spouse. Section 7.3, minor child. Section 7.5, income retained in the trust. Section 7.8, non-resident. Right. Was there donation? Is the donor still alive? No. Or if no, section 7 applies, you do section 25B. If someone has a vested right, or if an amount was paid to them, they are taxed on it. If no one has a vested right and the amount was not paid, so it's the income retained in the trust, then the trust will be taxed on that. So that is what we're going to come back the whole time. So when I repeat that question, you know what we are going through. Okay, you should do it in the exam as well. So here we go. In 20x2, John Langley created the Langley Family Trust for the benefit of his family. So I want you to understand this trust was not created in terms of a will. At the time that the trust was created, John donated, very important as you see there, a fixed deposit with the bank of 4 million rands to the trust, which earns interest evenly throughout the year. Now guys, when you do a trust question, you should receive a distribution account with it. It's important for you to then identify, you see here at the top, who the donors are. So this interest received over here, that comes from the information from John, right? So at the top here, I'm going to put, if there is any donor, we'll say who it is. So John is the donor. So that's important. Remember, if it was donated, section 7 can apply. Then, next up, John's wife Samantha sold 3 holiday homes in Cape Town to the trust at their market value at that time. These holiday homes are let out to holiday makers and earn a decent amount of rental income. Now, I want you to see here, in this case, there was no donation. She sold it at market value. If they don't say anything about interest or anything like that, guys, you have to assume that everything is fine. So this is no donation. Right, so the rental income over here, there is no donor. Then, John's father, so John is the one who created it, John's father, Roy, knew that the trust would benefit his grandchildren. So Roy donated local shares and foreign shares to the trust, and these shares earned dividends on the 1st of May and the 1st of October. So a couple of things I want you to see. So first up is that the local dividends here, Roy donated it, and the foreign dividends, Roy also donated it. Then I just want you to see they give us those same dates here, 1st of May, 1st of October. Over the years, the trustees have invested the undistributed income generated from the holiday homes. So they're saying this holiday income here, any amount was not paid out, they've reinvested it in foreign bank accounts, and that generates foreign interest. And this interest was received during the year. So what I want you to see is if we look at this rental income over there, the amounts at the end of the year, they usually reinvest and they put it into foreign interest. So that foreign interest came from what donor? From no donor. So this also doesn't have a donor. Understand that if they reinvested Roy's money and they put it in there, the income from Roy, then that would be from Roy. Alright guys, so up to that point in time, what I want you to now just see is if you consider section 7, right, so I'm talking about section 7, this question here, we have to consider this whole story. When will we consider that? You will consider it for John, for Roy, you will not consider it for the no donors though. So only where there were donors, so that's important for you to see. Okay, then they tell us, John and Samantha have 3 children, Lizzie, who turned 18 on the 31st of August 20x5. Now in this case, the question asks us to do it for the 20x6 year. So I want you to just see. So this is for Lizzie. The tax year runs from 1 March 20x5 to 28 Feb 20x6. On the 31st of August 20x5, she turned 18. So what that means is for 184 days she was a minor, and for 181 days she was not a minor. And then, so that means during this period, section 7.3 can apply, and during this period, section 7.3 may not apply. Right. Then we have Herbert, who is 23 years old and a resident of Australia. So that means he is a non-resident. And a non-resident, you'll have to consider section 7.8. Then we have Pam Langley. She's 26 years old, so she's not a minor, and she's currently finishing a training contract at a medium-sized audit firm. Alright, so there's nothing strange there. Then they tell you on the 28th of February is the last day of the tax year. John was 53 years old and Samantha was 48. So then guys, they now give us all of this information. The trust deed contains the following information. Lizzie has a vested right to 30% of the local and foreign dividends. Herbert has a 50% vested right to the local and foreign dividends. Pam has a vested right to the local and foreign dividends, 20%. So I just want you to see guys, this is what you're seeing over here. Here's the local dividends and here's the foreign dividends. Right, so it's these amounts that they are distributing. Right, then they tell you Lizzie is entitled to an annuity of $490, which is paid out of local interest, rental income, foreign interest. Herbert has an annuity, Pam has an annuity. Right, so just to show you the annuities, Lizzie, Herbert, Pam. Right, there are the amounts which are spread out of the different portions. Okay, then, very important. In terms of the trust deed, Lizzie, Herbert, Pam, each have a right to 25% of the foreign interest that is not distributed. The undistributed amounts will be paid out to each of them once Lizzie turns 21. Should any of them pass away before then, the amount will be paid into their estate. So that means they have a vested right to it. The remaining 25% must be retained by the trust and reinvested. So what they are talking about is if you look at your foreign interest, the 7,000 rands over there, 25% of that amount is split as follows. Lizzie gets 25, Herbert gets 25, Pam gets 25, and the trust will get the remaining. Then, no person has a vested right to any other undistributed income of the trust. Now that means these amounts that you see over here, no one has a vested right. Alright, then Roy passed away on the 1st of September. So who is Roy? He is this grandfather of the children. Now what is important there is that section 7 only while he is alive. If he passed away on the 1st of September, then it means he was alive for 184 days and 181 days he was deceased. So you can only apply it during the period that he was alive. Alright guys, so now we just need to distribute all of these amounts. So let's go through it. So the trustee's remuneration, tax in the hands of the trustee. That's fine. Okay, so here we go now. So now we're going to ask this question the whole time. Was there a donation and is the donor still alive? Yes or no? If you say yes, you say that section 7 apply. If you say yes, then the donor is taxed. If it doesn't apply, right, then we look at section 25B. Then the person who has a vested right or the person who was paid will be taxed. If no one has a vested right and the amount was not paid, then the trust is taxed. So I'm going to ask it the whole time, and that is what we come back to. Okay, so the whole time, guys. So for each of these amounts, so the first one is the 48,000 rands local dividends to Lizzie. Was there a donation and is the donor alive? Yes. At this point in time, on the 1st of May, so let's actually make the comment here. Roy was alive. Roy was dead on the 1st of October. Right, so at this point in time, the 48,000. Was there a donation and is the donor still alive? Yes. Does any of the section 7s apply? Well, Lizzie was a minor at this point in time, but section 7.3 only applies to a parent. Roy is a grandparent, so it does not apply. So if section 7 does not apply, section 25B must be applied. Who has a vested right? Lizzie. Who should be taxed on that 48,000 rands? Lizzie. The same with the 135,000 rands foreign dividend. Was there a donation? Is the donor still alive? Yes. Does section 7 apply? No. Who has a vested right? Lizzie. Who should be taxed on it? Lizzie. So for those two amounts, the 48 and the 135,000, make sure you see we go to Lizzie. There's the 48 dividend. It is exempt in terms of section 10(1)(k). Remember conduit pipe. There's the 135,000 rands foreign dividend. It's exempt in terms of section 10(b). 25/45. Right. So those amounts, guys, for Lizzie, done. Next up, Herbert. Now what do we know about Herbert? He is a non-resident. So for non-residents, we have to consider section 7(8). Okay, so the 80,000 and the 225. Was there a donation and is the donor alive? In both these instances, it's Roy that donated it and Roy was alive. So yes. Does any section 7s apply? Section 7(8) applies. So who should be taxed on that? The donor. Who is the donor? Roy. So that 80 and 225, make sure that you see now what happens here. I was going to take you down to Herbert first. To Herbert. The local dividend and the foreign dividend, section 7(8) applies, so he is not taxed on it. Can you see? Then we go to Roy. Roy, on the 1st of May, the distribution to Herbert of the local dividend and the foreign dividend, he gets taxed on it. He still gets his exemptions. Right, so those amounts also done. Then we have Pam. 32 local dividends, 90,000 foreign dividends. Was there a donation and is the donor alive? Yes. Does any of the section 7s apply? Well, what and who is Pam again? Pam is 26 years old. She's local. She's just doing her articles. So there's nothing strange about Pam. So who should be taxed on that? Pam. So make sure you see now. We go down to Pam. Pam. Local dividend 32, exempt. Foreign dividend 90, exempt. Next up, which is important, is on the 1st of October, Roy has now passed away. So, let's go through it. So the first one is Lizzie, 48,000 rands, local dividend, 135,000 foreign dividend. Was there a donation? Is the donor alive? We say no. So we only consider section 25B. Does she have a vested right? Yes. Was it paid out to her? Yes. So who should be taxed on that? 48 and 135? Lizzie. Doesn't matter what her age is. She is also not a minor anymore. But there's the 48, right? Exempt. There's 135,000. There's exempt. Okay. That's done. Now pay attention to Herbert. Herbert's the big one. In this case, the big example. Was there a donation? This 80,000 and the 225, local and foreign dividends. Was there a donation? And is the donor still alive? No. So we have to consider section 25B. Does someone have a vested right? Yes. That person should be taxed on it. So that local dividends of 80,000 rands and the foreign dividends, Herbert should be taxed on it. But now, what is important to remember about a non-resident gross income? It's only on income from a South African source that you can get taxed in South Africa. So the 80,000 rands is local dividends, the 225 is not, it's foreign dividends. So make sure you see now what we do. We go down to Herbert. Here's the 80,000 rands, local dividends, and there is the foreign dividends. He does not get taxed on it because it is not from South African source. Right, then Pam, the 32 and the 90. Was there donation? Is the donor alive? No. Does someone have a vested right? Yes, Pam does. So who should be taxed on that? Pam should be taxed on that. Here we go. All right. Now we get to our annuities. Now the first annuity, Lizzie, she got 70,402 from interest. Right. Was there a donation? Is the donor alive? Yes, John. Does any of the section 7s apply? Well, John is her father. What do we know about Lizzie? She was a minor for 184 days of the year. So for 184 days, section 7.3 applies. For 181 days, it does not. They tell you in the beginning of the question that the fixed deposit earns interest evenly throughout the year. So that means we can apportion it. So watch this 70,402. Right, if you go to John, the father, for the period that she was a minor, section 7.3 applies. So he got taxed on it for doing that period. He gets the normal interest exemption. After that period, right? So this is the first period when she was still a minor. We are looking at Lizzie at the moment. We are looking at Lizzie. John was taxed, but look at the period when she was no longer a minor. Who got taxed there? Lizzie got taxed. Right, so done. Then the next one, this 337,931 over there, is rental income. There was no donor. Next, the 81667 over there is foreign interest, also no donor. Was there a donation? Is the donor still alive? No. So who should get taxed on it? The person who has a vested right who was paid out. So who's going to get taxed on those amounts? Lizzie will be taxed on it. So we go to Lizzie. There are those amounts from the annuity. Right. Then we have Herbert. So make sure you see with Herbert. The 89799. Was there a donation? Is the donor alive? Yes. Does any of the section 7s apply? Yes. Section 7.8 applies. So who should be taxed on it? The donor. So John is the donor. John. Here's the annuity to Herbert. Look at the interest. Herbert gets, or John gets taxed on it. The interest exemption, he's already fully used it up there. Then just remember, you need to go down to Herbert and just make the comment. Those taxes in the hands of the donor. Right, that's the first one. Then there's the 431034 and the 104167. The rental income and the foreign interest. Was there a donation? Is the donor alive? No. So who should be taxed on it? The person who received it. So the 431034 is from a South African source, so Herbert will be taxed on it. The 104167 is foreign interest though, so Herbert cannot be taxed on it. Right, so look at Herbert. The rental income he can be taxed on, but he cannot be taxed on the foreign interest because it's not from a South African source. Then we have Pam. Was for the interest, was their donation as the donor alive? Yes. Does any of the section 7s apply? No. So who should be taxed on it? Pam. The 342,069 and 82667, was their donation as the donor alive? No. Who should be taxed on it? Pam. So just for all of those ones, you'll see Pam gets taxed. Right, then we have the income retained in the trust. Now guys, this is where people make mistakes. Pay attention to how this is treated. This is the only place Section 7.5 can apply. And Section 7.5 applies if there is a donation plus no one with a vested right. Okay, so I'm going to start you with the 7,000 rands foreign interest. The 7,000 rands foreign interest, I'm going to remind you, they told you that each of the children have a vested right to 25% of it, and the remaining 25% that remains is no one has. So, the 25% to Lizzie of the 7,000 rands, was there a donation and is the donor alive? No. So who should be taxed on it? The person with a vested right. Lizzie has a vested right to 25% of that. Okay, so let's see Lizzie. Income retained in the trust, 7,000 times 25%. There she goes. So even though it hasn't been paid out to her, she has a vested right. That's Lizzie. Herbert, was there a donation as the donor alive? No. Does any who should be taxed on it? Herbert. But this is foreign interest. It's not from a South African source. So can Herbert be taxed on it then? Herbert, can he be taxed on it if it's not from a South African source? No. And then the last 25%, first one is to Pam. Was there a donation as the donor alive? No. Who should be taxed on it? Pam. The trust, was there a donation as the donor alive? No. Who does it belong to? It belongs to no one, so it's kept in the trust. So who should be taxed on that? The trust. Make sure you see there, the trust is taxed on it. So here's Pam, income retained in the trust. Here's the trust, income retained in the trust. We're looking at this one at the moment. There we go. Okay, now pay attention to the next one. The next one is, let's just look at this rental first, the rental income, the 28,966. Was there a donation and is the donor alive? No. Does it belong to someone? No. So who should be taxed on that? The trust. So see that 28,966? The trust gets taxed on it. Okay, now pay attention to the next one, which is important. 6034, which is interest received. Was there a donation and is the donor still alive? Yes. Does any of the section 7s apply? Section 7.5 will apply if there was a donation and if no one has a vested right. No one has a vested right to that. So section 7.5 will apply. So who should be taxed on it? John. So make sure that you compare the 6034 and the 28,966. The 28,966 is taxed in the hands of the trust because there's no vested right and there's no donor. The 6034 is also no one with a vested right, but it's taxed in the hands of the donor because of section 7.5. So here's the 6034 for John.